Investing for the future. It's an issue none of us can afford to ignore. Hardly anyone's job is safe these days. How would you cope if you lost yours? We're all living longer too, so are you saving enough to fund 25 years or more of retirement? Can you really afford to pay for your children or grandchildren to go to university or help them onto the property ladder? And what about all those holidays you promised yourself? We entrust the vast bulk of our investments to fund managers. Here in the UK, according to Her Majesty's Treasury, the industry has more than £4 trillion of investors' money under management. Fund managers invest our savings wherever they see fit, mainly in equities or shares in listed companies. They claim to be experts at making our money grow, at picking the stocks that will outperform the market. But all too often, they disappoint, producing returns that are lower than the average return for a benchmark index such as the FTSE 100 in London or the S&P 500 in the States. For veteran investment guru John Bogle, the problem is simple. Fund managers just aren't as smart as they like to think they are.
I came into this business when I was at Princeton, and I worked for a brokerage firm in the summer. And one of the old runners said, "Bogle, I'm going to tell you everything you need to know if you're going into the investment business." And I said, "What's that, Raymond?" And he said, "Nobody knows nothing." And that's true. We don't know what the future holds. We have all these opinions out there, and we've got to say, I'm smarter than everybody else. And that just isn't going to happen.
It's absolutely possible for active fund managers to beat the market, and to beat the market consistently over time. But there's also the question of probability. And when you assign a probability to a fund manager beating the market consistently over time, it's very, very low.
Ultimately, of course, fund management companies are businesses. They exist to make money for themselves. They want our business, even if it means persuading us to invest in funds which the managers themselves wouldn't risk putting their own money in.
They will put out any product that they think the public will buy, whether the companies have any belief that that product is any good, because the idea is to gather assets. The idea is to bring in as much money as you can and manage it. And if that product fails, you could then take that money and convince the client to go into a different product that you're coming out with. Back in the 1990s, the turnover of mutual funds was only about 3% per year. Now it's up to almost 6% per year, so it's almost doubled.
So, to summarise, regardless of the impression they like to give, fund managers regularly produce less than the average market return. Buying and selling shares is little more than a gamble, and strong returns are often down to luck. It's harder than ever before for a manager to outperform the market consistently. Commercial pressure means fund managers often advertise funds they wouldn't choose for themselves. And remember, although there are good managers out there, picking the next star manager is almost impossible. It's now time to look at what it actually costs to invest. Like all businesses, fund managers have overheads. Running a fund management company isn't cheap, especially when the top managers earn around £2 million a year, including bonuses. And remember, it's you, the customer, who picks up the tab.
To me, most of these investment companies are just purely marketing companies. Let's set up a fund, let's see what we can sell, and it's never really about what's good for the investor, it's about what's good for the investment company.
Ultimately, fund managers need to make a profit. In fact, they're making around £10 billion from us every year, and that's regardless of whether or not they manage to produce a profit for us.
The job of a stockbroker is to transfer the wealth of the client to themselves. Typically, they extract in the range of 2 or 3% of their assets per year from the clients, and if you do that over a period of 20, 30, 40 years, eventually your broker winds up with more of your assets than you do.
We all get a return from the stock market in the long run. Now, let's say for the purpose of argument that that's an 8% return. But we in the markets get the net return. after the insanely high costs of financial intermediation. And those can be as much as, say, 2% a year. Wall Street, if you will, in America, gets 70% of the return and puts up none of the capital and takes none of the risk. And we get 30% of the return, we investors as a group, there's no way around this, for putting up 100% of the capital and 100% of the risk. That is just crazy.
So, in addition to those hidden charges, what else are we as investors having to pay? And more importantly, what impact do charges have on the value of our investments in the long term?
You might be looking at 1.5% per annum or more in management fees. It doesn't sound very much, but if you're talking about an investment strategy lasting over 20 years, it's a large amount of money that you're actually paying over to the fund manager. And you want to make sure that if you are doing that, you're getting what you're paying for.
Studies are being carried out, and the FSA is very active in this, on emphasising that one of the main determinants of longer run wealth destruction is the charges. Now, people tend to underestimate the effect of, say, a 1, 2 or 3% charge each year is a very substantial reduction in the wealth.
So, in summary, fund managers have large overheads, not least salaries and bonuses, and you pay the bill. Over time, charges that sound modest can seriously erode your savings. Many of the charges that consumers incur are hidden in the small print. And to add insult to injury, fund management charges have been rising year on year. So conventional active investing, in other words, paying someone to pick your investments and decide when to buy and sell, is expensive. And as we've also heard, only very few managers are able to outperform the market consistently. But is there an alternative? A strategy that costs us less but produces a higher than average return after costs in the long run? Yes, there is. It's called passive investing.
Passive investing is really more about the vehicles of choice for a given investor. So it's about using index funds as opposed to trying to select active managers that may or may not ultimately best their market benchmark.
Although it accounts for only a small share of the wealth management industry in the UK, passive investing is much more popular in the United States. American academics have made a compelling case for it since the 1950s. In the 60s, economist William Sharpe developed the capital asset pricing model, for which he was later awarded a Nobel Prize.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of two key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected, for bearing risk, but the kind of risk for which the reward should be available is the risk of doing badly in bad times.
After the capital asset pricing model came the efficient market theory, developed by Eugene Farmer and Ken French. The idea being that shares are always priced correctly because they already reflect everything that's publicly known about a company. More and more Americans were beginning to realise that paying a manager to buy and sell individual shares was a waste of time and money. It was while working as an investment specialist in New York that Tim Hale came to the same conclusion. He believes that many active managers happily gamble with other people's savings while quietly investing their own money in index funds.
A quick example was when I first arrived there, was trying to put forward together an investment performance track record for the firm that I was working for, and ultimately, being unable to find consistent performance, within the data that we had, and I think that began to sow the seeds of doubt in my mind. My pension plan was full of passive investments, which I think is quite a telling sort of indication of, I guess, the increasing cynicism.
As company pension schemes become less popular, investors are forced to do it for themselves, so they need to be more and more aware that the low charges associated with, say, passive investment will ultimately, over very long periods of time, benefit them considerably relative to being with active fund managers.
So, to summarise, passive investing is not so much a theory as a matter of mathematical fact. There's a wealth of evidence supporting it, including the work of Nobel Prize-winning economists. And studies have consistently shown that when costs are factored in, passive investing produces better returns than active. Of course, one of the golden rules of investing is not to put all your eggs in one basket. And the cheapest and most effective way to diversify is to invest passively. Why pin your hopes on the shares of just a handful of companies when for less money you can spread your risk by taking a stake in the entire market?
There's a rule in real estate that the three most important things are location, location, location. Well, my rule in investments, the three most important things are diversify, 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 and then I'll give you three more: keep costs low, keep costs low, keep costs low. And the simplest way of doing that is a very broadly diversified, very low-cost index fund.
Active fund managers like to give the impression their funds do spread the risk you're taking. But while index funds often hold hundreds or even thousands of stocks, a typical managed fund will only hold around 50. So if you choose an active fund, you're opting for greater volatility and you're paying a premium for the privilege. Not only does the passive approach offer diversification within a fund, it also allows you to buy entire asset classes. There are index funds for virtually every type of asset, whether it's European equities, commodities, or UK gilts. And even when you put your money into riskier assets, you're still spreading your risk by buying the whole market. An argument often put forward by proponents of active fund management is that when asset prices fall, they often do so across the board. True, an index fund tracking, say, the FTSE 100 will rise and fall in direct correlation with the index itself. But despite the disappointing performance of equities since 1999, a passive investor would still be sitting on a sizable profit now, as long as they'd spread their investments, particularly when dividends are taken into account. On average, they'd also be better off than if they'd put their money into actively managed funds.
The remarkable thing about finance is you cannot predict at all what the market is going to do tomorrow.
So let's summarise. Investing passively is the cheapest and most effective way to spread your risk. Because their holdings are restricted to a relatively small number of stocks, active equity funds are more volatile than passive ones. Active fund managers charge a premium for funds that invest in more than one asset class. And over the longer term, once charges are taken into account, the passive investor will always fare better than the average active investor. You might be thinking this all sounds just too good to be true. Passive costs you less money, and yet it offers you ultimate diversification. It's good for your health and ultimately your wealth. But if passive really is superior to active in so many ways, why aren't more people doing it? Let's find out. Perhaps the single biggest reason why active still holds sway is the fund management industry itself. It's a powerful sector with a vested interest in maintaining the status quo.
When you have a market that's $1 trillion, and they're able to scrape off $20 billion a year or 2% per year from that to feed themselves, they don't want to give that up. So there's an awful lot of marketing and a lot of convincing of the public that they need active management, that they need to pay 2% per year. It's all about keeping the money in the pockets of the people who are creating the funds as opposed to putting the money in the pockets of the people who are taking the risk.
Of course, the industry spends vast amounts on advertising. The news media might also play a part in making us invest the way we do.
We could have an article week after week after week telling people, passive investing, that's the way to go. that story gets old. There's no news here. Versus, I'm trying to write an investment story. This week, I have this really beautiful, articulate woman who's got a strategy. Next week, I've got this really handsome, outgoing, gregarious guy who has a strategy. They all make the cover of my magazine, makes it much more interesting. Versus me, put me on the cover, you're not selling anything.
The main reason why active investing is still far more popular than passive is a simple lack of awareness among the general population.
Primarily, I would say it's a lack of education. But then secondly, passive funds, because they don't make much money for the financial companies, while they do make money for us, they're really not promoted.
It's not about getting investment returns or superior returns above the rest of the market or beating our competitors. Our job is to educate the general public. And I do believe over the next 10 to 15 years, the general public will realise that the only way to have a successful investment experience is to own as much as the market as you can, be well diversified, and make sure that you sit in a really, really diverse portfolio with substantially reduced charges.
In summary then, the largely self-regulated fund management industry has a vested interest in maintaining the status quo. Human beings have a tendency towards overconfidence, and that's reflected in the way we invest. And while active funds are widely advertised, passive funds aren't, and nor do they command much media attention. One former active manager who converted to passive says many active managers privately admit that passive makes much more sense.
When I converted over to passive and I started writing about index funds and how my peers are going to have a very difficult time beating the market, and here are the statistics and here are the data, I can't say that I was invited to any more parties. I can't say that I was shunned because I could show up to the parties just because I was part of the group, but I wasn't invited anymore. Now, I will also say, though, that one-on-one with my peers, in a private setting where nobody could hear the conversation, they would readily admit that it was very difficult for them to beat the market and that they personally believed in what I was doing.
And this is what Warren Buffett, the world's most successful active manager, says about passive investing. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees.
I think with a lot of investors who go into the passive investing side and go into the indexing side, it's a road of self-discovery. So something sparks them to start looking into it. And once you start looking into it and you read a book and it leads to another website, it leads to another video, and all of a sudden you have like what I had, which is a chemical reaction. And you say, I get it.